what's your podcast about? Man, I don't even know how to answer that question. It's about conversation. It's about speaking with people and having dialogue about, things that are going on around us, things that we see in society, and just having our opinion on those things and meeting different people and speaking with them, getting to know them, getting to see how different individuals think, how different individuals see life, That's what the podcast is really about, and that's what you're tuned in, hosted by the one and only Uncle Kevin.
Hello, guys. How you doing? Welcome back to the podcast hosted by your favorite Uncle Kevin. Today we'll be talking finance with Uncle Kevin. Without wasting much time, let's get into it. Today we'll be looking into one of the stories that we touched on a few weeks ago, which was about the Luna coin. It keeps on making headlines. A lot of people lost a lot of money, man. A lot of money. I couldn't believe it. I still cannot believe the numbers. Apparently, $3 million turned into $3. I do not know if you believe that, but yeah, $3 million turned into $3. I laugh not because it's funny. I laugh because it's unbelievable how much one can lose. When you lose that much, damn, man, it's a lot. As we continue to look at it, there's this article written on CNBC by Mackenzie Sigalis. Some investors got rich before a popular stablecoin imploded, erasing $60 billion in value. Man, something has to be done about this crypto stuff. One of the greatest things about crypto when it was introduced to me was it's going to be decentralized, not controlled by the government, because we do not trust the governments, That's just how the people are. That's just the most popular thing is we do not trust the governments. We want to be decentralized. We want to put power back in the people's hands. But what tends to happen a lot of times is when power is in the people's hands, it gets abused. And in this case, I feel it's the same thing that happened. And now we find ourselves in a situation where $3 million turned into $3. In May, the collapse of one of the most popular US dollar-pegged stablecoins project cost investors tens of billions of dollars as they put out in a panic that some have compared to a bank run. A stablecoin known as terraUSD and its sister token Luna experienced a pretty spectacular run-up before it all collapsed. Venture capital firm Pantera Capital tells CNBC their $1.7 million investment in Luna turned into $170 million while Hack VC and CMC Global exited their Luna positions in December and March respectively. So yeah, a lot of people, the good thing with what I've read and done my research on Luna was it was actually one of the most stable coins. It's in its name. I think it had a 20% promised growth from the day that it started, and it was sustainable for people. People thought this was a great space to put your savings. This was a great space to do whatever. And what happened in this case was as the crypto crash started to happen, people started looking for stable coins to put their money whilst the crash was happening. And what happened is, as people started putting money into Luna, someone somewhere did the dump thing. The what do they call pump and dump? Somebody did the dump and then started dumping a lot of money, and a lot of people didn't realize what was going on because this was promised to be a stablecoin, but the stablecoin had issues, and boom, we went from $100 down to $1, or is it 10 cents? It's just ridiculous. In May, the collapse of one of the most popular US dollar-pegged stablecoin projects cost investors tens of billions as they pulled out in a panic that some have compared to a bank run. But before that, the stablecoin known as terraUSD, and this is had experienced pretty particular run-up, and some investors made a killing before it collapsed. The scheme relied largely on faith and the promise of future returns, plus a complex set of code with very little hard cash to back up the whole arrangement. Unlike USDC, another popular dollar-pegged stablecoin, which has a fiat assets in reserve as a way to back their tokens, UST was an algorithmic stablecoin created and administered by Singapore-based Terraform Labs. It depended on computer code to self-stabilize its value by creating and destroying UST and Luna in a sort of supply and demand seesaw effect. For a while it worked. UST held its dollar peg and the Luna token soared. The Luna tokens rose to more than $116 in April, up more than 135% in less than 2 months. Traders were able to arbitrage the system and profit from deviations in the price of the two tokens, but perhaps the greatest incentive of the entire scheme was an accompanying lending platform called Anchor, which promised investors a 20% annual percentage yield on the UST holdings. This is something that a lot of analysts said was unsustainable. But listen, if something is offering you 20% in terms of your savings, I'm all for it, man. I'm all for 20% because a lot of times, just keeping your money in your bank account, it's at a 0.5% saving interest, and inflation right now is like, I know in Canada, this is just me guessing, it's probably at 3.5%. So you're not really making money by keeping money in the bank, and where inflation I read somewhere it was projected to reach 7%. So it's like if you're making 0.5%, you're really making a loss. So if someone offers you 20%, that's a lot of money, and you know that the S&P 500 gives you on average 7% over a period of time in terms of the money that you make. So if something offers you 20%, this is something that a lot of people would be interested in. At 20%, I think it would take you almost like 5 years to double your money. So if you put in 400,000, the chances of you hitting a million in a couple of years is something that's lucrative and something that you'd look into. And a lot of people, especially those that started saving and investing late, would have seen this as a massive opportunity to get into this. And yeah, widespread buy-in and public PSAs from respective financial institutions lend credibility to the project, further driving the narrative that the whole thing was legit. Most everyone was happy until it all came crashing down in early May. It's sad, man. Like in April, it was up 116 and it went down to 10 cents. Most everyone was happy until it came early May. Although the project did amass about 3 billion worth of Bitcoin in its reserve as a backstop for UST when the price of Luna became unstable, investors rushed out of both tokens, sending prices off a cliff. The Luna Foundation guide tried to restore UST's dollar peg by spending almost all of the Bitcoin in its reserve. It didn't work. At their height, Luna and UST had a combined market value of almost 60 billion. Now they're essentially worthless. The entire episode has laid bare the advantages of experienced large-scale investors over retail investors gambling on hope. Yeah. One person posted on Reddit that they didn't think they would have enough money to pay for their next semester at school after losing money on Luna and UST. Another investor affected by the crash tweeted that she and her husband sold their house and bet it all on Luna, noting that she was still trying to digest whether it was actually happening or just a nightmare. See, people, here's the thing, man. There's no such thing as get rich quick. You gotta work. It's a marathon. Anything that seems too good to be true is too good to be true. The number one rule when it comes to investing is only invest money you're willing to lose. Do not invest money you are not willing to lose, because there is no guarantees. There is no get rich quick. It doesn't work that way. Yes, it's a game. It's a game that's played over and over. But the number one thing is it's all risk. High risk, low risk, whatever risk. There is risk you will lose. This comes with the territory. So do not put money. Do not sell your house. Do not do something stupid. Do not do something in hope that something works out. Yes, you sold your house. You invested it on Luna. I hope you understood what Luna was. You know what I mean? Like, do not try and make a quick profit and then lose and cry. You cannot cry. That's the game that you're playing. There is a winner. There is a loser. Someone is bound to lose. Okay? In this case, these people who sold their house, which I do not understand why you would sell your house only to invest it in a crypto that you do not understand how it works. Now look at you. Where will you stay? Just to try to digest whether what was actually happening or just a nightmare. Others are contemplating suicide after losing all they've got. There's no point of committing suicide, man. It's just a thing. It's crypto, fam. It's a new technology that we are all learning, and we're trying to figure out how to make money off of it. You win some, you lose some, okay? I'm lost about to commit suicide in a chair. One commenter posted already, I lost my life savings in the investments of Luna UST. The worst thing is that 3 weeks ago, I proposed to my girlfriend. She doesn't know anything. I lost $62,000. I'm here. I don't know what to do. Listen, if you have $62,000, the last thing you want to do is put it in crypto. The last thing you got to do is put it all. You cannot put all your eggs in one basket, fam, when it comes to crypto. You got to be very careful. You have a thing called Bitcoin, which was making people a lot of money. It came from like $56,000 down to $29,000. Like, yo, that should have been like, yo, what's going on? And pay attention to it. But I think, yeah, man, Among the winners of the UST flash crash are Pantera Capital hedge fund that saw 100x return on investment. You see, you should also know when to exit when it comes to investments. Joey Krug, the fund's co-chief investor officer, told CNBC that in the primary fund where they held and traded Luna, they sold about 87% of the position from January 2020 through April. Pantera then sold another 8% in May once it was clear the UST pair get broken. At the end of it all, Krug says Pantera got stuck with about 5% of their position. All that liquidation translated to a return of $171 million on a $1.7 million initial investment, assuming remaining Luna they own continue to be worth nothing. So yeah, the other thing that happens a lot of times with investing is Warren Buffett has a quote where he says, you want to buy when everyone is running and you want to sell when everyone is buying. Essentially what this means is you have to have an exit strategy when it comes to investing, especially in things that are speculative like crypto. You have to know at what point do you reach your profits and exit, and then, let it go. A lot of times what happens, and the thing that's the challenge with a lot of people is seeing the success of Bitcoin. A lot of people thought this would be an opportunity to get rich quick, because if you get in, you spend $62,000 on when Luna was $50. You're assuming if it rises to the level of Bitcoin, hits $10,000, man, you're super rich. But the thing is, the chances of that happening are super low at this point, because Bitcoin might just be a unicorn. Bitcoin, Ethereum, these things might just be a unicorn, but you never know. So if you're willing to take a risk, take it. But it's called risk, okay? Yeah, there's a chance you lose everything. We think it's one of the most promising coins for the coming year, Mohed said of Luna. So many people are just discovering it and it's just starting to trade it. But Krug says the firm's initial decision to liquidate came to risk management and rebalancing the fund. Risk management. For the large portion which we sold over 2021, part of 2022, it was really simple risk management, said Krug. It kept becoming a larger and larger part of the fund, so we had to de-risk it, since you can't really run a liquid hedge fund with one position being super large portion of the fund. When Pantera noticed breaking in May, so again, it was really just seeing the peg break from a few cents and pattern matching it to historical currency pegs. Continued Krug. So you can see that the big boys, what they're doing is they keep reading and they keep looking at the data. You don't want to be ignorant and be left on a dying horse, because yeah, you'll be left crying almost about to commit suicide. Let's look at these people with tattoos of the Luna thing. Listen, man, crypto, I do not know how it gets overhyped as a asset, as a financial asset. It's just an asset. It's like buying stocks. There's no emotions in this. And for some reason, when it comes to the crypto space, people become super fanatic. It's to the moon. It's our thing. But the thing with money is money has zero emotions. It really doesn't care about you, and in a way, you don't have to care about it. It just goes wherever the value is, that's where it goes. In as much as we are saying $60 billion of value was wiped out, it just means 60 billion moved to another section, to another sector of people. Somebody made off that 60 billion. It didn't just disappear. Money doesn't vanish into thin air. It trades hands. So, why? Man, this is sad, man. This is really sad. Is there a road to redemption? Terra's backers have voted to revive the failed venture. The proposed rebuild involves a new Terra blockchain and getting rid of the beleaguered stablecoin that helped trigger the meltdown of the original project. It could also mean redemption for the institutional and retail investors who got wiped out. For those who saw a big loss, the relaunch could potentially translate into an opportunity to recoup losses on initial investments. Delphi Digital, for example, has disclosed that it is currently sitting on a large unrealized loss after miscalculating the risk of a debt spiral event coming to fruition, and CoinDesk reporting shows that SEO-based Hashed Ventures lost over 3.5 billion. Man, these are jobs. These are people's... It's just sad. It is sad. Terra's... Okay, let's get into this.
Climbing since February, it's now at an all-time high. If Bitcoin were to move sharply in either direction, it could catch some of those leveraged investors offsides and, as Fundstrat puts it, compound a move in either direction. On top of all that, Bitcoin is still very much tied to the macro outlook, which is still looking tough for some of the riskier assets, with quantitative tightening starting and the Fed raising rates. Bitcoin right now is struggling to avoid its 9th straight week of declines, trading pretty much sideways for most of the week, near $29,000.
Okay, on to the top stories. We mentioned earlier how Ether prices are getting hit today. The second largest cryptocurrency by market cap is having a rough week, down nearly 15% since Monday. That's leading to unusual liquidation activity, according to CoinDesk. Investors pulled out about $236 million from Ether-tracked futures, which usually sees fewer liquidations than Bitcoin. That could be a sign that Bitcoin is becoming a safe haven amid the volatility hitting the rest of the crypto markets. Tether is expanding into the Polygon network, making its dollar-backed USDT token now available on 11 blockchain networks. With a market cap of more than $72 billion, USDT remains the most popular stablecoin in crypto. For the most part, it's been able to withstand the volatility affecting other tokens, remaining pegged to the US dollar on a one-to-one basis. Backers of the Terra blockchain network just voted unanimously to burn 1.3 billion UST tokens. Burning cryptocurrencies, of course, means to remove them from circulation. By burning 11% of the UST reserve, the backers hope to reduce the bad debt of Terra's economy and restore UST's one-to-one dollar peg that recently crashed to near zero. With Luna pegged to UST, this mass burning is expected to help bolster Luna's price as Terra plans to bring back the token, which we'll explain more in a bit. As we just mentioned...
Man, this just goes back to tell you, man, the crypto space is a space that I feel like on this podcast we're going to have to learn a lot more about, because for me it's just becoming interesting how especially to see how they'll recover this Terra thing. From a brand perspective, I don't see how it will work. But listen, if I'm riding a dead horse and there's hope that it will wake up, hey man, I'm trying to make my money back.
And there's still a lot going on with Terra and the fallout of UST plummeting to zero. Earlier this week, Terra backers approved a plan to revive Luna, the token tied to failed algorithmic stablecoin UST. The new version of the Terra blockchain is expected to go live overnight with a Luna airdrop at 2 a.m. Eastern. As part of the Luna revival, Terra plans to distribute tokens to holders of UST and the older Luna digital currency, which will be renamed Luna Classic. Whether or not the revival plan will work remains to be seen, but the fallout from the collapse of UST is still weighing on crypto markets and sentiment. We took a deeper look at how we got here in the first place, starting at the beginning of the Terra project. The sudden collapse of Terra sent shockwaves through the crypto industry. According to Elliptic, holders of UST and Luna lost a total of $42 billion. Major investors like Coinbase Ventures lost millions of dollars as well. Galaxy Digital CEO Mike Novogratz, he's stuck with a tattoo of Luna on his arm. It's a shocking collapse of a cryptocurrency that reached record highs just a few weeks earlier. So we have to talk about how we got here. Terraform Labs was co-founded in January 2018 by Daniel Shin and Do Kwon, a graduate of Stanford University and former CEO of networking technology startup AnyFi. A year later, Terraform launched its governance token, Luna, with a starting supply of 1 billion tokens. Then, in September of 2020, Terra launched its algorithmic stablecoin, terraUSD, also known as UST.
In the middle of 2020, right around when DeFi summer happened in the crypto space, I came across the Terra blockchain because it was one of the few blockchains that actually had significant amount of revenues. They made a lot of network fees. And what made them unique was that they had one of the first, decentralized stable coins that actually saw real world traction with, millions of users in South Korea.
Let's take a second to talk about algorithmic stablecoins and how they work. Stablecoins are called that because they're designed to remain pegged to a certain price, usually $1. Traditional stablecoins are considered over-collateralized, meaning the token's operator holds real fiat currency in reserves to support the stablecoin's price, $1 for $1 worth of that token. Algorithmic stablecoins are considered uncollateralized. They don't use fiat currency to back up their value. Instead, these tokens operate on a network alongside another cryptocurrency. They maintain their pegs through algorithms that encourage traders to take advantage of price changes in both the stablecoin itself and that secondary cryptocurrency, in this case, the Luna token.
So the idea is that at any given time, you can trade in $1 worth of terraUSD against the protocol for $1 worth of Luna, and then vice versa. So you can sort of think about Luna as absorbing the price volatility of Terra stablecoins.
And in the 2 years after its launch, UST and the Terra blockchain saw insane growth.
Terra has really evolved into being more than just, an algorithmic stablecoin. It has also...
This is the crazy part. It's how smart these people are. And how they communicate and how confusing it is. Like, oh yeah, this works off of the blockchain. So now you have to read what the hell is a blockchain? And then you have to go down. And then you have to be like, okay, how does the Luna swallow the volatility of Terra. How are these two things? And then you're like, you know what? I'll just put my money in there, 20%.
A layer one blockchain, and it went from being an underdog in 2020 to being, a top 10 crypto and really on its way to being the number one stablecoin in the world.
One huge driver of growth was a service called Anchor.
The Anchor protocol is a borrowing, saving, lending platform inside the Luna ecosystem. The mechanism there was if you are a saver, so you can deposit UST and earn 20% yield, which, sounds too good to be true. On the other hand, you could borrow UST and you pay maybe 25% in APR, but there is a mechanism called the distribution APR where you are actually being paid anywhere from, let's say, 25.1% to maybe even over 100% for borrowing. So if you log onto YouTube and you search for videos around how does Anchor Protocol work, you're going to find a bunch of videos that are like how to make passive income by borrowing on Anchor Protocol.
With all this attention, UST surged to an $18 billion valuation. And to maintain that value, Do Kwon turned to Bitcoin to support terraUSD's reserves.
We usually buy about like $150 million clips every few days. And we do some of those things through board resolution. So that really depends on how fast people get back. But I would say we've bought about $1.6 billion so far. And I think by the end of April, we should be at around 3.
This latest move rallied the so-called lunatics, pushing the price of a Luna token to an all-time high of $119. But crypto markets have struggled so far in 2022, with growing concern of a recession and bear market. Bitcoin's price was slowly falling, and fears of a crypto winter were rising. For Terra, those fears culminated in the second week of May.
I'd say the trigger was on May 7th, when on the platform, a decentralized finance application platform called Curve, which is often referenced by traders to assess the stability of the peg of stablecoins, there was a major trade that was made where someone came in and exchanged $85 million of UST for another stablecoin. And this started to cascade into additional exits in these liquidity pools. And this caused the initial depegging and the beginning of the spiral. The next kind of key event or moment would be the series of exits from Anchor Protocol. Luna really should have a much higher market cap than UST for the entire ecosystem to be valuable and facilitate these redemptions. However, in this period, the market cap flipped, and this further exacerbated the legitimate fear of Luna and UST holders, thus deepening the spiral as more people were fleeing for the door. Then, essentially, I'd say the last piece is the deep hyperinflationary spiral. Luna hyperinflated over 8,000% in a matter of just 2 days, and there is now trillions of Luna in circulation. This is all augmented by the fact that this ecosystem was under-collateralized by its Bitcoin reserves, so people are incentivized to not be left in the dark and flee for the doors and be the first out.
That's all for this week, but we'll be back again next Tuesday after the Memorial Day weekend. See you then.
Yeah, man. It's crazy how this coin got here, but it had great potential. It's just a lot of oversight in terms of, I guess, the business of it and how they thought things would work out, especially like how the lady was explaining how the Luna network or Luna coin works, where the algorithm just prints more Lunas to cover whenever there's a there's a withdrawal. Listen, man, I'm sorry, I don't mean to laugh at anybody, but yo, this is just hella weird. How now they have $1 trillion coins on the market. Anyway, educate me in the comment section, but it's just sad, man. It's really sad when you read and do research on what happened to Terra and Luna, because hey, how you go from $116 to 10 cents, I have no idea. People lost a lot of money, man. But I saw it's up $6. So if you got in at 10 cents, hey, you made somebody. Get out as quick as you can. With that said, this will be the end of us speaking about crypto. We're moving to more finance news. We're looking at Todd Boehly completes takeover of UK's Chelsea Football Club. Man, I'm always interested in these topics. This one, we're getting it from Yahoo Finance, written by David Hellier on Monday, May 30. Bloomberg, US investor Todd Boehly has completed his $4.25 billion, $5.4 billion US takeover of Chelsea's football club from the sanctioned Russian oligarch oligarch. Do you say oligarch or is it oligarch? Roman Abramovich. Chelsea confirmed the completion of the deal in a statement Monday. It ends almost 20 years of ownership under billionaire Abramovich, during which the club rose to become one of the most dominant forces in the English Premier League. Abramovich was forced to put out the team for sale earlier this year, shortly before being sanctioned as part of UK's response to Russia's war in Ukraine. Rain Group, the US advisory firm, was tasked with handling the sale of one of the biggest brands in European sport. Man, when this thing was happening, I was actually shocked that it was actually happening, because I just thought, nah, there's no way. He's been the owner for 20 years. And they're not going to take the team from him, and then things just got weird, like to a point where they were like, Chelsea cannot afford to fly. You're like, yo, what? The club received more than 250 inquiries from proposed purchasers, Chelsea said in a statement. Ultimately, the club received 12 credible bids. These were whittled down to just 3, the Boyle beating out competition from rival consortiums led by British businessman Martin Broughton and Bain Capital co-chairman Stephen Pagliuca. There was also a late proposal from British billionaire Jim Ratcliffe. Boyle's winning bid is backed by California-based private equity Clear Capital. It includes a £2.5 billion purchase of shares and $1.75 billion for further investments to benefit the club. Man, it's interesting how we say $1 billion. It's a lot of money, but in soccer these days, it's really not. Like, I think there are players with buyout clauses of $1 billion. So just a player. You look at someone like a story we just did on the podcast, Kylian Mbappe, who's making $300 million in 3 years. So whilst $1.75 billion is a lot of money, that's just essentially like 5 players. And you're out. The process was complicated by the need to comply with sanctions, ensure none of the proceeds found their way to Abramovich, but instead to charitable causes. The bid was signed off by EPL and UK government last week. See, I've never really believed in charities. I do not know how this will work, but I'm pretty sure the man will make his money, man. There's no way he's just letting it go. Like, that's $4 billion, We're all in 100% every minute of every match, Boyle said in a separate statement, along with our commitment to developing the youth squad and acquiring the best talent. Our plan of action is to invest in the club for the long term and build on Chelsea's remarkable history of success. Goldman Sachs Group Boyle was advised by Deutsche Bank AG and Goldman Sachs Group. Goldman Sachs seems to be in a lot of financial stuff, because I'm pretty sure they're the ones again in the Twitter deal. Like, these people know how to be involved with money, fam. Like, I feel like, whatever they know, we need to know. We need to really sit down with some Goldman Sachs people and be like, yo, how do you guys end up in every deal, in everything that happens? I think I should do a video on what Goldman Sachs is and just see. Because, maybe I'm wrong. Was that on JP Morgan? But yeah, Goldman Sachs is in everything. I've seen their names in a lot of things. And they're always involved in these big money deals. In terms of what I think about this, listen, soccer has become a money pit, a money game. It's all about who's got the most dollars. When you look at teams like Manchester City, teams like PSG, where they're backed by the oil money straight out of the Middle East, so a lot of them, they can afford a lot of they can afford to buy players, to invest a lot of money through endorsement deals and whatever they do. In terms of this takeover, I don't know, like at $4.75 billion, it's a lot of money, but you still have to put in more, especially to compete at the world stage. I think football in general has the potential to generate a lot of revenue, especially from fan bases, because a lot of fans are really willing to spend a lot of money on their favorite teams. So it is possible to generate a lot of cash from it and make it a sustainable business. But the challenge is turning a football club into a profitable business. It takes time, and it takes a lot of planning, a lot of thinking, and a lot of organizing to do, which might not work for your fans, because people want to win tomorrow. No one wants to win 5-10 years down the line, because every year the competition goes on. So it'll be fascinating to see how Chelsea continues to move with Abramovich. A lot of times they got the players they wanted, they paid the wages they needed, everything seemed to run smoothly, and he was a quick decision maker. So now it's interesting to see how Chelsea moving forward will operate. But yeah, congratulations to these guys for getting the club. It's in a lucrative market. I mean, the club is based in London, and London is very popular, and especially for American companies trying to expand into the UK, into Europe as well. It's a massive opportunity, and there will be massive opportunities that will come up from this. So it's interesting to see what's going to happen for Chelsea. I know there's always a lot of complaints with Americans owning football clubs as well. I mean, when you look at Manchester United, there were challenges with that. Arsenal, there were challenges with that. So it's interesting to see how everything develops and moves forward. It's one thing to be a billionaire. It's another thing to be really invested and wanting to see the team succeed. So I can't wait to see the future of Chelsea Football Club, in terms of how they'll operate in the markets, the players they'll try and get, and how much money will be put into the team and how far it'll compete. With that said, I think that's pretty much it for this story. So let's move on to the next one. This is a fascinating one, man. So as we all know, one of the challenges that you have when you work minimum wage jobs is it's a minimum wage job, and rarely does your salary ever increase. You can work at a job, if you step in at $12, by the time you retire, the most you'd have made is probably $16. That's the raise you'd have gotten, and a lot of times that's not enough, especially for the work that people put in. In this case, we'll be talking about one of my favorite companies, Apple. In a leaked audio, Apple VP gives Apple Store workers anti-union speech. In an internal video circulated among Apple's 58,000 retail employees, Apple's vice president of retail suggested that a union would make it more difficult for Apple to improve working conditions. Well, this is always tricky because a lot of times when what unions do is they come and they want to implement things for their members. And what tends to happen a lot of times with unions is it becomes a power grab, and it becomes a power issue whereby the leaders want to have a lot of influence. And a lot of times the businesses want to have a good relationship with the union leaders, but also it's like, oh, in order to have a good relationship with the union leaders, it's not really going to impact the members. So it's always tricky. We have a relationship that's based on open and collaborative and direct engagement, which I feel could fundamentally change if a store is represented by a union under a collective bargaining agreement, said Deirdre O'Brien, Apple's vice president of retail, in a 6-minute video circulated yesterday among Apple's 58,000 retail employees in the United States. Details by the video were reported by The Verge earlier Wednesdays. Anyway, let's listen to the audio and then we can continue with the article.
Questions about. And this is the union discussions that have been happening in the US. I want to start out by saying that it is your right to join a union, and it's equally your right not to join a union. And if you're faced with that decision, I want to encourage you to consult a wide range of people and sources to make sure you understand what it could mean to work at Apple under a collective bargaining agreement. Over the last few years, we have been through so much together, and we've worked hard to always pull together. Our guiding principle throughout is to do our best, to do what's right, and to always support each other. And like our credo says, to learn and to grow. And together, we've made so many changes and adjustments to the way we support our customers and the way we support you. From raising pay to giving special bonuses, from additional vacation and sick leave days, to expanded new parent leave, to paid family care, and emergency backup care for all team members, full-time and part-time. I cherish the relationship that we have. In my view, that's what makes our experience at Apple so special. It provides the foundation for us to be open and honest with each other, to listen and to learn together, and to respond to feedback in real time. We have a relationship that's based on an open and collaborative and direct engagement, which I feel could fundamentally change if a store is represented by a union under a collective bargaining agreement. And I worry about what it would mean to put another organization in the middle of our relationship, an organization that does not have a deep understanding of Apple or our business, and most importantly, one that I do not believe shares our commitment to you. Apple moves incredibly fast. It's one thing I love about our work in retail. It means that we need to be able to move fast too. And I worry that because the union would bring its own legally mandated rules that would determine how we work through issues, it could make it harder for us to act swiftly to address things that you raise. I'm committed to and proud of our ability to act fast, to support our teams, to support you. But I don't know.
There's there's a lot of issues in what she's saying. What they're saying. It's from what I'm gathering, the union doesn't benefit Apple at all. But then it does benefit the employees. Because listen, if you're underpaid, if there are issues at work, one man's voice in a business with 100,000 employees is going to take time to be listened to. But if the union is there, they do have the legal mandates to get issues solved. So this is a big thing to think about. You know, it's a big, let's continue.
That we could have moved as quickly under a collective bargaining agreement as it could limit our ability to make immediate, widespread changes to improve your experience. And I think that's what's really at stake here. I am deeply committed to making Apple the best it can be for you. Everything from scheduling to pay and benefits to development to the experience and the environment in the stores and the things that are important to you and your individual journey. I know these things mean a lot to you, and they mean a lot to me too. It has been great to be with so many of our teams over these past few weeks. I always learn so much through my visits and other interactions with you. I know we have room to improve, and there are some areas where we need to move even faster. And I'm always so appreciative that you share your feedback with us so that we can build our plans together. Very soon, we'll be sharing the results of our most recent pulse survey and our plans to act on what we've learned. Your feedback is essential to us. I want to thank you for all that you share with us. I love the saying that feedback is a gift. It truly is. And I want you to know that we are listening and will continue to listen so that we can support you and make your experience at Apple even better. I'll close by saying that I really look forward to continuing to build on our very special culture and the relationship that we share together. So thank you for everything that you do for our customers and for each other, and for all that you bring to Apple. I'm so grateful for this team. Take very good care, and I look forward to seeing many more of you in person soon. Bye-bye.
Yeah. Interesting. Because what tends to happen in relationships, right? The person who's benefiting the most doesn't want it to change. It works for them. It works for Apple. This lady is probably she's a vice president, so that means she's up there in the C-suite. You know, she is paid to make sure. I don't know if it's a lady or okay. Listen, we're getting into that territory. Listen, they work for the business. They work for Apple, talking to employees. They are not representing employees, so. Yeah, the relationship works for the corporation, but if the relationship is not working for me, I'm the one who's suffering. You know, the reason I need a union, the reason the union came up as a thing is because I'm suffering. And it's because I'm giving you feedback. I've been talking, but the relationship is not working. And we need to introduce something that has the power to get your attention. That's the issue right now. The issue is not whether the union is good or bad. The union is bad for Apple, because they can bully our business. But if it's 58,000 of us coming as one, then there's an issue. Then it starts to affect your bottom line. Now you have a problem, and now you want to act. That's how this works. Not how she's going or they're going. This will happen, that will happen, that will happen. Nah. See, I hope they do vote to become part of the union and do what they need to do. O'Brien, sitting in a wood-paneled room with potted orchid and framed photos of Apple's corporate campus, goes on to use other standard anti-union talking points favored by employers looking to crush unionization efforts among their workers. I'm worried about what it would mean to put another organization in the middle of our relationship. an organization that does not have a deep understanding of Apple or our business. O'Brien continued, and most importantly, one that I do not believe shares our commitment to you. How is that even possible when the union is just all the team members coming together, banding as one and creating a collective agreement? They understand the business. They are in the business. You know what I mean? It's not like they're hiring. It's not like there's a company called union that you hire from the outside. It's the group of them creating this thing that will protect them. So listen, the video arrives amid an unprecedented unionization drive at Apple's retail stores. Today, Apple retail workers in Louisville, Kentucky publicly launched a union campaign, becoming the fourth US store to do so since mid-April. Apple retail workers in New York, Atlanta, and Tulsa, Maryland have also announced union drives. To date, Apple workers have yet to win a union election at any of the company's 272 retail locations in the United States. This is because of intimidation. If someone's like, if you unionize, we'll fire you, and you probably need the job. In the video, Brian also suggests that the union will make it more difficult for Apple to work on improving conditions for its retail workers. How? Apple moves incredibly fast, she says, and I worry that because the union would bring its own legally mandated rules that will determine how we work through issues, it could make it harder for us to act swiftly to address the things that you raise. This is the problem for them, because now when issues are raised, there's a legal mandate to actually fix them and do something about it, not just to say it's pending, not just to say it's this. It's because yes, we work together. If it means slowing down a bit so that things don't just happen and whoosh, I'm screwed and you're good. Yeah, man, come on. Come on. It turned my stomach, an Apple retail worker and union organizer who viewed the video and requested to remain anonymous said, as someone who genuinely likes my company but is working to organize my store to hold its own values, I'm disappointed not only in what was said in the video, but also how convincing it will be to some people that are on the fence. Apple retail workers have cited pay, benefits, and unpredictable hours as reasons for the unionization push. They also want Apple, the world's most valuable company, to share more of its profits with frontline workers who sell iPhones, MacBooks, and iPads. A large body of research indicates that union workers earn significantly more than their non-union counterparts. The benefits of unionization are even greater for Black and Latinx workers, research shows. This is true. I know a friend, we used to work in the retail space together. He worked for London Drugs and they were unionized. He made more than double what we were making. And he was even an immigrant. You know, as an immigrant, you get treated a little bit different. But, you know, it is what it is. But he was making more money than us. We were not unionized, you know. No one was holding guns to our heads to show up to work, but we did show up. And we got paid what we got paid. I wish I wasn't a union. I wish I got paid. I had zero rights. I had nothing. I would speak up. We asked for raises, man. They gave us 50 cents. Man. Yo, man, if you work for Apple, you have opportunity to get into a union, I would suggest you do it. Because, listen, Apple is making money. At some point, this company was making $1 billion a day. So, come on, you deserve to eat a little bit. Earlier this month, Motherboard published a series of anti-union talking points that Apple has circulated among store leaders at unionizing retail locations. Apple has not publicly said that it opposes unionization, but these talking points, along with the video, suggest that Apple opposes unionization efforts at the company. That is true, man. Like, listen, if you're Apple, for your bottom line, you don't want no union. You don't want none of that smoke. You're like, yo, keep that stuff away from us. Okay, that's what's happening. So you think they're just going to say, yeah, bring it. They don't want none of the smoke, okay? They don't want it. Retail workers at Apple have filed for union elections with 3 separate unions: the Communications Workers of America, Workers United, and International Association of Machinists. The campaigns arrived during a moment of widespread enthusiasm for unions in the United States and a wave of unionization of major anti-union employers, including Amazon and Starbucks. Yeah, man. In the end, it's fascinating how things work. If the relationship works for me, I'm not gonna try and improve it, because whatever the situation is, as toxic as it is for you, it's working for me and my bottom line. If it's not working for you and your bottom line, hey, who cares? That's what Apple is simply saying right now. You think they will come out and say no to unions? Man, that will affect their brand. So don't come out and say that, but they will, by virtue, just go around and be like, yo, no, it will, our relationship. There is no relationship, fam. You have no relationship with Apple. If traffic is slow and there's a slow market, your hours will be reduced. That's just how it works, because they're not making money and they don't need you. But you need to be paid because you need them hours. You know what I mean? Like, you need to be covered and you need someone to protect you, someone to speak up for you when you're not in these rooms and these decisions are being made based on algorithms and numbers, you know? So I don't know, man. I don't know. I'm just saying, I don't know. If I work for Apple at the retail store, I'll probably be joining the union. If I work for Apple and I was a C-suite executive, listen, I'm saying no to unions. Okay, I understand both sides. So at the end of the day, the only way you can win is think about yourself. Worry about yourself. What gives you the most benefit? If joining the union makes you eat a little bit more, why not? Is what I'm saying. With that said, we'll move on to the next story. I can tell you, I know exactly where the market is heading. Just kidding. Okay, so now our final article is from the New York Times. I know the decline has been unnerving, but readers want to know how nasty this year's downturn may become. All right, New York Times tries to answer this by Jeff Sommer. The stock market's decline this year has already been painful. The key question for many people are how excruciating it will ultimately become and how they can endure it. The numbers aren't pretty. The S&P 500 is down 13.3% from its January 3 peak, and last Friday it briefly fell below the 20% threshold that defines a bear market on Wall Street. We should do a video on what a bear market is and the different types of markets that exist. But stocks rose 6.6% this week. The first weekly gain in 2 months is certainly conceivable, though I think unlikely that the worst of the damage is over and that the downturn of 2022 was just a flirtation with a bear market, a short affair that was never consummated. That has happened before and fairly recently at that. Do you even remember the market people during Christmas week in 2018? It had been falling for months as trade tensions between the United States and China mounted. The December 24, the S&P 500 closed 19.8% down from its peak, leaving just a smidgen above the 20% bear market line. On the day after Christmas, it dropped briefly into bear market territory only to rally smartly by the end of the day, said Howard Silverbert, senior index analyst for S&P Dow Jones Indices. The market went on to gain more than 44% until its next big stumble early in the COVID-19 pandemic in February 2020. Will this year's market turn out to be another shy bear, one that has barely shown its face only to disappear for months, or will it return as a ferocious beast that will punish investors who do not protect themselves from harm? Alas, I don't know the answer to that one, though I find it hard to accept the idea that this year's cascading stock market declines are over. There seems to be many negatives weighing on the markets, among them the Federal Reserve's decision to tighten interest rates in response to soaring inflation, the continuing ravages of coronavirus, the high price of oil and gasoline, and the war in Ukraine. Still predicting where the marketing will head is a fool's errand. And that's true. Like with markets, man, you can't really sit down and predict what's going to happen. You have to really think about the flow of things, because the market basically follows the people, you know, with demand and supply and stuff like that. What's been happening is, yes, we're in inflation. Yes, the price of living is going up. The war in Ukraine didn't help. The increase in gas prices does not help at all, because an increase in fuel and an increase in oil in general, it affects production. And then you're looking at a lot of challenges that we've been facing, especially in the past 2 years with the coronavirus, how that hampered production. You know, if you look at a product such as a PlayStation, you know, it's still hard to find a game that came out 2 years ago, you know, or is it a year ago? But it seems like a long time now because of chip shortages. So when you start to look at manufacturing, and a lot of things are being affected, and then when the cost of gas goes up, it affects the cost of production. And then with inflation added on top of it, we are just in a weird space in terms of global markets right now. So a lot of things will be going down. A lot of people do not have that money to spend. It's a struggle to make money because opportunities are very few right now, because everybody is either trying to mitigate the effect of the increase in costs and inflation, so spending gets cut. And then we end up in these situations that we are in, where a lot of, the valuation of companies is going down because there's just not enough money to spend. And then the bubble that we lived in for the past 2 years because of the stimulus checks and the whatever checks that were coming out, and people had money, people were not spending money, people were not traveling, people were not doing a lot of things. A lot of people became investors in that period of time as well. So now we're just in a weird phase, which I hope we'll get out of, but I don't know, the best we can do is make educated guesses based on history and prevailing conditions. As an investor, I hope the market rises immediately, but I'm preparing for further declines, buying stocks and bonds regardless. I've been doing this for decades. Tons of academic research suggests that it's fruitless to try to outsmart the market. So I use diversified low-cost index funds that track the entire stock and bond universe in the expectation of long-term gains. This approach makes sense for people with long horizons, but the earlier you need the money, the more difficult your choices will be. Plenty of people have written to say they're grappling with these issues. Keep the questions coming. I'll answer as best as I can. They include, so watch and wait or jump right in. Because the stock market often falls, I wouldn't invest a cent in it if I needed to spend it soon. Pay the bills first. I've suggested several alternatives for stationing your cash. They include US government bonds, which now yield 9.62%, a rate that is reset every 6 months. Other short-term treasury bonds and high-quality corporate bonds are reasonable choices. Listen, I am not a financial advisor, so do not take this as my advice. I'm reading this article off of New York Times. If you go ahead and buy some bonds that you have no idea how bonds make money and you lose money, do not come back to me. The only thing that I can say when it comes to the stock market is you have to be very careful and you have to do a lot of research and understand what type of investor you want to be. If you want to be a retail investor, if you want to be a speculative investor, that's on you. Okay? Go ahead, spend your money, time the market, make some money. Listen, good for you if you do make money. If you do end up losing money, the number one rule of money is never lose money on the stock market. And rule number 2 is never forget rule number 1. So do your research, read, and understand what's going on. Listen to a lot of podcasts like this. Do your research. Watch, markets, how things happen in the end. Because a lot of times what happens, a lot of us don't want to do the research. A lot of us don't want to read. We just want to be told, do this and everything will work out. But the thing is, when it comes to investing, when it comes to money, there's a lot of risk that is involved. The risk might be minimum. Even if they say it is a 1% risk, that risk there is a 1% chance that you might lose it all. So that's where we find ourselves in right now. If you're a long-term investor, I would say it's a good time to purchase a lot of stocks as things are going down. If you do have the cash, go ahead and do it. Don't keep your money in the bank account. Inflation is going up. Things are happening that are weird and your money keeps on losing value. So you might want to start investing in some low index funds that are available. The S&P 500 for me is something that I believe in. I feel like business will keep booming. Things will go back to normal and things will go back to where they were pre-COVID, pre-the war, pre-everything. I do believe in that. However, I'll be very skeptical in terms of how long it's going to take us to get there because there's a lot of issues that are happening at the same time. We're in a bear market. You're looking at, increase in cost of borrowing. You're looking at increase in prices because of the gas prices as well. So there's a lot of issues that are happening right now. We're also heading into this recession that we've been told for the past 4 or 5 years because the market just works in a cyclical cycles in a cyclical formation. So at some point we're up, some point we're down. At this point, we are almost at that point where we hit the recession and we have to be prepared for everything. The best thing that I know is if you either want to have cash or you want to invest it, but you really want to have cash because a lot of things are going to go down. People are going to become desperate. People are going to start needing money. And that's when opportunities present themselves and those with the cash have the opportunity to do something. With that said, I hope you guys enjoyed this week's podcast with your favorite Uncle Kevin. We were talking finance, we talked business. We looked into everything, man. We looked into Luna crypto. We looked into the Americans buying Chelsea. We looked into Apple trying to bully its employees into not being part of a union. And we finally looked at the stock market. Let me know in the comment section what you thought of the podcast, issues that you had with the podcast, advice that you give us on what to do when it comes to our finances. I really enjoy doing this with you guys, having you guys listen. And yeah, with that said, leave us a subscribe, leave us a comment. I'll see you next week with another Conversations Talking Finance with Uncle Kevin. See ya.